Three-day losing streak coming into Monday. Big week coming right up. Live from New York City this morning. Good morning, good morning. Future's just about positive. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
Live from New York, we begin with the big issue. Earnings season kicking off.
Earnings.
Corporate earnings.
Q3 earnings.
We're going to look for guidance from CEOs and CFOs.
Investors are looking for outlook.
Investors want to hear management speak.
A lot of companies have failed to provide outlook and any guidance and certainty.
How are they going to maintain margins?
How much corporate earnings are being hurt by interest rate rises?
How are they going to navigate this incredibly difficult and very rapidly changing economic environment?
And how much corporations are able to pass on the effect of higher inflation?
We've had big markdowns on earnings.
We're expecting a lot of revenues and profits to be hit.
We're going to start to see companies generating negative operating cash flow.
That is the next thing that the market has to focus on.
That's really going to be the next trigger in terms of the market coming under pressure.
Joining us now to discuss is Flowbank's Esty Dweck. Nuveen's Tony Rodriguez. Esty, first to you. Charles Evans of the Chicago Fed right now saying optimistic we can reduce inflation and avoid recession. Do you think that optimism is misplaced?
Well, at this point, not yet. Although the more the Fed tightens, the tougher it's going to be with soft landing. We are seeing tentative cracks in the labor market, not quite in the non-farm payrolls, but the jolts finally came down a little bit. We're seeing some softening in growth, but at the same time, consumption seems to be holding up pretty well. And as we said, unemployment is holding up. So far a decent mix for the Fed. But if inflation doesn't come down over the next couple of months, they're going to continue to tighten pretty aggressively. And that could definitely have pretty bad effects for 2023.
And perhaps 4.5% is as far as they'll go. Tony, that's what Charles Evans is saying right now. Back in rates around 4.5% in 23 and on hold for some time. What's the some time? How long?
Well, good morning, Jonathan. Good to be with you. And while I appreciate Charles's optimism, it may be a little bit too much of rainbows and unicorns. So I think 4.5 is a possibility. We would say 4.75 is more likely. But we do think that they're likely to hold throughout 2023. So while we think the economy is going to be in recession, we think it'll be a relatively mild recession, and we think that the Fed will actually pivot to rate cuts sometime in early 2024.
2023 up to 475 and hold through much of next year. Esty, plug that into what this would mean for the equity market. If we went to 475 through much of next year, how much pain would we see?
Well, the futures market is already pricing somewhere between 4.5 and 4.6. So 4.75 is a bit above where we are. I think as long as we don't hit that 5% mark or more, the market is pretty much pricing most of it in and should be able to withstand it. We've seen earnings expectations come down, not just for this earnings season, but also for 2023. Right now, we still have those rate cuts priced in for the end of 2023, but it's still a little early to say that the Fed would not look through that. That's, over 12 months to get inflation back to 2% and then potentially see what the growth impact is and if the economy needs some help to come out either of a shallow recession or of a very sharp slowdown. In any case, that's what they're going to engineer. So right now, the market's probably pricing in something close to that. Anything much more hawkish for longer, I think, would be quite painful.
Esty, last time we spoke, you thought the June lows would hold. They didn't. What went wrong, do you think?
Well, I think a couple of hot inflation prints really was the worst of it. And the market, I guess, was expecting a pivot. I don't know who thought we would pivot to dovish. I mean, pivoting to a pause or to see what the rate hikes are doing. Let's keep in mind, this is the fastest pace of rate hikes the Fed has ever done. At some point, they need to see what the impact is. You don't see that after 1 month. So we're going to have, 4% of hikes within 6 to 9 months, and the Fed is going to have a look at that too.
Futures up 1/3% on the S&P, and the Nasdaq up 0.2%. CPI is just going to hijack the conversation later this week with regards to the Federal Reserve. Then it's on to corporate America. JP Morgan on Friday morning. These corporations, corporate America right now, has to face a growing list of headwinds. Relentless monetary tightening, a surging dollar, and an incoming read on inflation, all weighing on sentiment. Kelly Lyons has more. Hey, Kaylee.
Hey, John. Yeah, it's not a great cocktail for corporate profitability, and we're going to get our first reads on that really coming this week. Along with JP Morgan, you have 14 other S&P companies reporting this week. The bulk of them, though, will come in the weeks to follow. Between the week of October 24th and October 31st, you have about 2/3 of the market cap and members of the S&P 500 reporting. So buckle up. It's going to be a bit of a long ride. But to your point, John, given all of the headwinds that these companies are facing, we have seen a deterioration in expectations for this earnings season the closer we get to it. Back in mid-August, about 2 months ago, analysts expected EPS growth of about 4.3% for the S&P. That number is down now to 2.6%. So definitely a slowdown compared to what we saw in the first and second quarters. But analysts are still betting that these third quarter results will represent the trough, with a rebound starting in the fourth quarter. We'll see how long, though, that optimism can hold up, considering we have seen things start to deteriorate in sell-side expectations. Analyst earning downgrades outpacing upgrades for 17 weeks in a row through the data we have at the end of September. And we've heard from a number of strategists consistently on the street who are warning we have not seen the worst of the downgrades yet, that more are on their way. And I would just point out, in our latest MLive survey released this morning, that poll survey showed more than 60% of more than 700 respondents say this earnings season will push the S&P lower, John.
Kelly Lyons, thank you. Tons of warnings this morning, including another one from Morgan Stanley's Mike Wilson, who said the following: last week packed in a year's worth of volatility, both up and down, as the market battle between deteriorating fundamentals and supportive technicals continues. Ultimately, fundamentals prevail in our view, but it could take longer than we would like. Esty, I'd love your view on the earnings season going into the big banks this Friday.
Well, everyone is expecting it to be poor. Earnings expectations have come down. Everyone thinks this Q3 is going to be the opportunity for guidance to be poor, for 2023 expectations to be brought down. The question really is how much is already priced in at this point of this bad news that pretty much everyone knows is coming. So I think we're going to get, of course, some pretty bad surprises. Let's say something, around what the FedEx said, although it's difficult to imagine much worse than the guidance that they gave. But I think we're also going to have a couple of beats, as we usually have. Tech should hold up better. And then the banks, so far we've seen that consumers are holding up. There's a little bit more of an impact at the lowest wage earners because of inflation. But beyond that, we're still seeing some solidity in the underlying consumption trends.
Tony, it's not a secret, is it? Things are bad. That's what Esty's getting at here. If the World Bank president and the IMF managing director are saying it, we're already there, and we were there a long time ago. The IMF managing director earlier this morning, Kristalina Georgieva, saying the risk of recession has gone up. Mr. Malpass, President Malpass at the World Bank, saying a real danger of a global recession. I think at this point, Tony, this is all well understood. How well priced is it?
Well, John, you bring up a good point. From our perspective, what's interesting is that we do think that the rates markets have priced in the vast majority of the move. So when we look at the 10-year, the 2-year, where Fed funds futures are priced, we think that we've really captured the majority of the move and are much more comfortable now from the standpoint of duration risk. Where we still see some more downside and don't think that the markets have fully priced in that downside is when we look at risk markets. We think that while earnings projections, as Kaylee pointed out, have come down, we do think they still have further to go. We still think it's a little bit too optimistic when you look at Q4 and when you look at the first half of 2023 from an earnings perspective. So we think risk premiums need to price in some more downside risk. So that is probably lower equities. It's also wider spreads when we look at high yield, emerging markets, investment grade fixed income. As we move through the balance of this year and the first quarter of 2023, we think you'll have some better entry points. We don't think they're going to be a repeat of the global financial crisis type of downside levels, but we do think you have a little bit more downside still ahead of us.
Tony, I think a lot of people would take some comfort, just a little bit of comfort, if the positive correlation between equities and bonds actually broke down. When can I start looking at a long bond that starts to behave like a long bond in a recession?
We think that as you turn the calendar that you really will be back to that more maybe traditional, typical bond market response and offset to your equity portfolio. We certainly think over the balance of this year, whether it's a strong CPI print possibly or some employment data that's maybe stronger, there's still a potential for a little bit of an increase further from here in rates, but we don't see the 10-year much above 4% at all. We think that we'll end closer to 3.5%. And more importantly, we think that as that economic weakness in 23 becomes very apparent to investors, we're looking at a year-end 23 10-year that will be down much closer to 3% than it is even to 3.5 or 4. So that's when duration risk and the bond market will begin to play the ballast role in your portfolio.
Tony, are you starting to lean into a little bit of duration, or is it too early?
Well, Jonathan, as you know, we've been pretty short from a duration perspective for the entire year. We're now pretty close to neutral. So we're not ready yet to say, hey, we've seen the peak in yields and we want to get long here, but we certainly leaned into it enough to cover our shorts and get pretty close to neutral because, as I said, we think that 90+% of the rate move is priced in.
Tony Rodriguez sticking with us alongside SD Twegg. B of A just published moments ago. Bank of America on their equity strategy team saying the following. Consensus feedback from clients. Third quarter might hold up, but who cares? Guidance is going to be absolutely terrible. They go on to say we expect a slight 1% miss in 3Q, but big downside risk starting in 4Q. We forecast $200 in 23 EPS versus the street at $240. We'll build on that in just a moment. Coming up, the BOE launching new safety net measures to calm the bond market.
The Bank of England is in a very tight spot. Eventually, it's going to have to stop buying those bonds and start going for QT.
And you'll get a fiscal announcement at the end of this month, a few days before the Bank of England meets. That conversation up next.
The Bank of England is in a very tight spot.
We have no direction yet on the future course of UK fiscal policy.
It's almost a kind of they'll do whatever it takes period of time.
It did the right thing, we think, by protecting the pension funds at very short notice. Eventually, it's going to have to stop buying those bonds and start going for QT. There is value in the UK market. It's just a question of if that value will be destroyed by political risk.
The UK ramping up efforts to ease market turmoil. The Bank of England expanding its emergency support for the bond market just as the government announces plans to deliver its fiscal strategy almost a month ahead of schedule. Team coverage starts right now with Danny Berger out of London and Kelly Lyons here in New York. Danny, run us through the latest.
Well, so we had the BOE essentially expanding these operations. So they're going to double the amount of daily auction that they can buy. It was £5 billion. It's now going to be up to £10 billion. Of course, only $5 billion of the $40 billion on offer so far has been used. So not a lot of usage, and that will still end on Friday. But it's not going to stop there. They are launching this temporary repo facility. The idea here being that those who need liquidity, especially those pensions under pressure, can tap this. They can also use collateral that goes beyond bonds. For example, they can put up corporate debt as well. Now, it's a 1-2 punch of the BOE and the UK Treasury trying to get ahead to calm markets. We also learned today that Kwasi Kwarteng is going to be publishing that fiscal agenda on the 31st of October. That's moving it up from November 27th. So now it's going to be ahead of the BOE decision. But still, John, it's going to come the same day that QT is set to start.
The gilt market's still all over the place. Kelly Lyons, your 10-year at 14 basis points.
Yeah, the reaction to the news of the BOE expanding this program is just yields higher. Granted, we are off of session highs. At one point, the 30-year gilt yield was up 22 basis points on the day. We're now up just about 15 basis points, but still at 453. We remain around the highest level we have seen going all the way back to 2011. One strategist over at TD telling Bloomberg that essentially the market is doubting if the BOE is going to fill the maximum number of orders. And also the fact that they're announcing these new measures today kind of signals that they aren't going to have any kind of extension on this emergency temporary bond buying program. Now, of course, over the last month, the moves have been even more dramatic. We're up 106 basis points on the 30-year on the month, up 146 on the 2-year at the same time that we've seen more weakness in the British pound off of the weakest levels from a few weeks ago, but still around 110. And as Danny alluded to, it's not just about October 31st. It's about what happens just a few days later on November 3rd when we get the rate decision from the BOE. And the market is expecting it to be less aggressive than thought just a few weeks ago. Right now, Andrew Bailey and Co. are sitting at 225. They are now expected to hike to around the 338 level. So essentially, the market is pricing in a 68% probability of a 125 basis point hike. Massive move, no doubt about it, but that is still less severe than markets thought a few weeks ago when we were discussing the likelihood potentially of an inter-meeting hike, John.
Danny, let's talk about the calendar now as it stands. So Kelly just went through fiscal announcement end of the month, November 3rd, the Bank of England. You said it. QT, the end of the month, on the same day that they deliver that budget. Danny, is that actually going to happen? Does anyone you speak to believe it will?
No, to put it simply, John. We were just playing sound there from Altaf Kassam of State Street, who I spoke to earlier, and said, no, there's no way the BOE is going to be able to go ahead with QT. If they are now being pushed around by the bond vigilantes, we're already seeing it today. Kayleigh pointed it out. This is a market that is testing the BOE. What will that test look like if they're going to have QT and a budget announced on the 31st? Look, it could happen that the budget comes out. It's clear that the deficit will come down. But considering the volatility as of late, this is a very fragile market. So you have the bond buying ending on Friday. You have QT and the new budget on the 31st, a rate decision then on November 3rd, followed shortly by other central bank decisions. And then this repo, that will stop, at least for the time being, on November 10th. John, a lot of potential risk events.
Danny, thank you. Looking forward to your coverage through the week as well. To Kelly Lyons, thank you very much as well. Jeffries had this to say. Long end gilts are coming dangerously close to levels where we could again see margin calls. They went on to say, and forced selling from liability-driven investment accounts. The BOE will need to step up the purchases this week to prevent further margin calls. Tony, are you interested in the gilt market just yet, or is this one still too volatile to touch?
You know, Jonathan, our head is spinning given the number of policy U-turns that you're seeing in the UK, both in fiscal and monetary policy. So we think that clearly it is too difficult right now. The volatility is too high to take any kind of really definitive position in that market. You mentioned a year's worth of volatility in 1 week in the equity market. In the UK, they've had a generation worth of volatility in the rates market in the last couple of weeks. So we think all this does is delay the BOE's need to address incredibly high inflation. So the problems in the UK are not being resolved by any of these policies, obviously. And the BOE's main problem is just becoming more and more difficult as we move through the year, given that they can't address it directly because of the volatility they're seeing in the rates markets.
It's taken some attention away from what's been happening elsewhere. I think we've all been looking at spreads in Italy, over Germany, through this morning, through the wides of the year, a little bit early this morning, back to about 251 basis points, call it 252. Esty, right now, the Italian 10-year just through 470. Is that becoming a bigger and bigger problem that the ECB might have to address and soon?
Well, I think that's what the bond market would like, right? Since they announced their new tool, everyone's been wondering how and if Italy would become eligible. Let's not forget that financial stability is an outright objective and part of the ECB's mandate. So if it becomes too unruly, if it becomes too problematic for Italy or for the rest of the European Union as a whole, you'd have to imagine they're going to act. As long as it remains orderly for now, they might allow it for some time, but the ECB is certainly going to have to give a lot more details on all these different policy tools and how they're going to address the spread widening to maintain this financial stability. In addition, because they're going to have to keep tightening to bring that inflation level down.
Tony, we've spent a long time now talking about policy and conflict between monetary policy authorities and what's happening on the inflation side and what's happening on the financial stability side. Can they achieve financial stability and get inflation down at the same time? Because at the moment, everything's very, very confusing, Tony. Rates up, maintaining some form of bond buying simultaneously. With that in mind, Tony, when does the Italian 10-year become a buy?
You know, Jonathan, our view has been that at this 250 level, it really begins to get the attention of the ECB. As we get closer to 300, we think the jawboning will begin in earnest. Once you get above 300 and that 3 to 350, that's when they're going to need to start actually talking about specific plans potentially to address that. If we get over 350, then we actually think they will begin to inject themselves in the market. So it's too early right now, we think, given all of the volatility and uncertainty, to make a stand on that Italian-German spread. But we think once you get to 300, that 300 area, it becomes a lot more interesting and needs to be evaluated carefully.
Well, let's set the scene for the end of this month. October 27th, is when the ECB next meets. Can they go 75 basis points month end?
You know, they can. They have inflation close to 10%. We'll see what the German number comes out as relatively, I think, in the next couple of days. Yeah, let's not forget that part of the mess in the bond market, including what's happening in Italy, is also kind of contagion from the UK. So we are not seeing a lot of stability, but this is not all about Italy. We haven't seen that many headlines since Mrs. Meloni became prime minister. So the ECB certainly needs to act to contain inflation. They know that the growth prospects are poor. Obviously, the escalation in the war in the Ukraine isn't helpful for inflation or for growth, but they could go 75 because they definitely need to address it.
SD Dweck, Tony Rodriguez, to the two of you, thank you. Some big central bank decisions coming up in the next 30 days or so, the next 4 weeks. The Bank of England being one, the ECB another, the Federal Reserve. Make it 3. Right now, the spread of Italy over Germany, 252 or 253 basis points or so. The yield on the Italian 10-year, 473, up a couple of basis points on a session. Coming up, the morning calls, and later, Pimco's Andrew Bulls seeing a more compelling case for bonds. We'll get his view on just that in just a moment around the opening bow. Going into the opening bow, 6 or 7 minutes away. Futures are positive, about 0.25% on the S&P 500. We're up by around about 9 points. Live from New York, this is Bloomberg. 5 minutes away from the opening bow. Futures just about positive on the S&P, up around about 0.25% on a 3-day losing streak coming into Monday. On the S&P 500 on Friday, biggest one-day move lower on the S&P going back to the middle of September. The same day we got last month's CPI report. The next one coming up a little bit later this week. Looking at the bond market, remember the Treasury market closed today for Columbus Day, so you look to Europe where yields are just shifting a little bit higher, and that spread between Italy and Germany gets a little bit wider through much of this morning. That level in and around 250. That's the price action. Here's some morning calls. First up, UBS downgrading Ford to sell, $10 price target, seeing little upside amid weakening profit margins and more macro headwinds. That stock is negative by more than 6% in the pre-market. Morgan Stanley cutting its price targets on Meta and Alphabet, citing low visibility for the digital advertising market. That stock on Alphabet is basically unchanged. And finally, Guggenheim upgrading Merck to buy, highlighting positive results from the drug maker's clinical trials. That stock is up by a little more than 2%. Coming up, stocks attempting to snap a 3-day losing streak on the S&P 500. We'll catch up with Pimco's Andrew Bulls, expecting further downside to equities as the bond market starts looking a little bit more compelling. We'll get Pimco's cyclical outlook next. From New York City this morning, good morning to you all, with futures on the S&P 500 shaping up as follows, advancing around about 0.33%. Your cash open just around the corner. 23 seconds away from the opening bow this morning. Good morning to you. 3-day losing streak coming into Monday on the S&P 500. Looking to snap that with futures positive about 0.25%. Call it 1/3 higher on the S&P. On the Nasdaq 100, up by almost 0.1%. As your opening bow, switch on the board and get to the bond market. Take a look at not treasuries, take a look at bonds. Treasuries closed today, back open tomorrow, of course. In the bond market, just like treasuries, yields have been climbing on a 10-year maturity for 10 consecutive weeks. Right now, 220 on a German 10-year. In the FX market, with the spread between Italy and Germany that little bit wider and going through the wides of the year earlier this morning, euro-dollar breaking down by 0.4%. Earlier on, 96 handle on euro-dollar. Right now, just about holding on to 97. In the crude market, monster rally through last week. WTI coming back down by 0.2%, $92 and around about 50 cents. Let's get you some movers. Let's do that with Abby. Morning, Abby.
Hey, John. Well, let's start out with some movers to the downside going in the opposite direction of this possible update, the first update in 4. And of course, Ford is plunging this on a downgrade over at UBS to sell and weak profit margins, also along with a tough macro background. Rivian also down sharply, down about 5.4%. They've recalled 13,000 vehicles to check a minor structural flaw. This just after they sorted out some of their production issues. And then Wynn Resorts down 3.2%. There was a weak holiday spending during China's Golden Week. So they are taking in their sales estimates. Those aren't the only movers, though, that are dropping this morning and this year related to China. Of course, the U.S. Commerce Department is rolling out sweeping new limits on tech sales to China. This, of course, could cause long-term ripples. Now, chips, as you know, John, are already in a world of hurt. The overall index down about 40% on the year. Big companies pre-announcing AMD last week down more than 10% on the day. NVIDIA over the summer. These new restrictions will not help. These tensions could really build. And on the day, we're not seeing the kind of declines that we've seen more recently, those double-digit declines. But nonetheless, AMD down about 1%, On Semiconductor down, NXP Semiconductors, both of those Apple suppliers, and then Applied Materials down 2.2%. That, of course, is a semi-cap equipment company, a leading tell on chips overall. And many saying that the chips, as you know, John, are the new transports, the tell on the economy.
We'll pick up on that story again in about 10 minutes. Time. We'll get the DC angle to all of that too with Anne-Marie Hordern down in Washington. Abby, thank you. About 2 minutes into this, we're up higher by a third of 1% on the S&P. Energy names had a monster run through last week. We're just about positive on this morning. We're up by a tenth of 1% or 0.2 on the session. The big banks kicking off earnings season this week. JP Morgan, Wells Fargo, Citi, Morgan Stanley, all reporting results ahead of the opening bell on Friday. That means one busy Shonali Basak. Hey, Shonali.
John, we have the moment of truth for these big banks as we see just how much money they've made in currency, fixed income, and rates markets. JP Morgan is expected still to bring in more money than a year ago at the trading business, helped by fixed income, but less money than a quarter ago. That is more than $4 billion expected in that fixed income unit. I want to also take a look at lending here because JP Morgan will really start off this conversation about bellwethers. So look at that rise in rates you're seeing, that 10-year Treasury yield, but then look at that decline you're seeing at the valuation of the S&P 500 Banks Index. That is because people don't like that inverted yield curve. They're really worried about credit quality moving forward. And about $1.2 billion worth of provisions for loan losses right now are expected for JP Morgan to report this quarter. We'll want to get Jamie Dimon's forecast again on that economic hurricane up front. Look at those earnings estimates there, just falling. Interestingly here, you have Morgan Stanley expected to fall 26%. They are reporting Friday. They are the richest of the big five banks, trading at 1.4 times the price to book, a little more than that. Goldman Sachs has been fluctuating all year just under book value. So the question is, are these priced to perfection when you're seeing the ones that are already trading on the lower side, or is there more to come? Remember, Morgan Stanley serves wealthier clients in its wealth management unit. Does that see pressure as times get harder ahead? And then, of course, there's your favorite story on Wall Street. Do they take more markdowns when it comes to those leveraged loan portfolios, given they have been so heavily exposed to some of the biggest deals on Wall Street?
Twitter, the elephant in the room there.
Exactly.
Shonali, thank you. Looking forward to your coverage. Their own research departments forecasting some gloom. Morgan Stanley, Goldman Sachs, both publishing new research highlighting headwinds stemming from slowing demand, soaring costs, and a strengthening US dollar. Kelly Knight says more. Hey, Kaylee.
Hey, yeah, John, both of these guys have sounded this warning before, and they're doing so once again as we get closer to this earnings season. I want to start with what David Kostin over at Goldman Sachs is saying, because he's talking about a number of different headwinds. Yes, on the cost and on the margin side, also when it comes to tax changes, and then the stronger U.S. dollar, which has just gone from strength to strength. It's up about 14%, even more so on a year-to-date basis. And since we ended the second quarter results, it's up another about 6% or so, stronger against literally everything in G10. And that is very problematic for big multinational companies with high overseas exposure because it makes products more expensive for international buyers, which can hit demand. And then any sales you are able to make become worth less when they're converted back into dollars. So Kostin points out that that stronger greenback historically has been linked to fewer sales beats, and that will support the performance of stocks with more domestic sales relative to those with a higher proportion of foreign sales. And we can see the discrepancy in the performance of some of those equities so far on a year-to-date basis. Then moving on to Mike Wilson's argument, which again we've heard a few times now, he's essentially paying attention to the cost side, pointing out inventory, labor costs, other latent expenses that are wreaking havoc, he says, on cash flow. And he says the bear market won't be over until the deteriorating fundamental picture is more fully discounted. He thinks that looks like the S&P 500 trading at a multiple of more like 13 times forward earnings to accurately reflect that. Right now, though, John, we're trading at 15.9 times.
Kelly, more pain to come. The message from Morgan Stanley. Kelly Lyons, thank you. The message from Pimco in their new outlook looks a little something like this. Andrew Ball is forecasting a shallow recession as his base case. The team writing, we see a downside risk for global equity markets, given starting valuations and earnings expectations that may not account for ongoing central bank tightening and increased recession risk. Andrew Balls, I'm pleased to say, joins us right now. Andrew, wonderful to catch up with you, sir. Let's start there. Recession, it's all we talk about at the moment. Are you telling me it's still not well priced?
I think shallow recessions are priced in. So if you look at fixed income markets, you look at credit markets, shallow recessions are priced in the US, in Europe. So one question there is just, how big the slowdown will be. But our asset allocation experts, our equity analysts, think that equity markets aren't pricing in enough. So a bit of a gap between credit markets and equity markets. Obviously, often the same companies involved, and so a positive view on credit versus equities, given that disparity.
And do you see the opportunity in fixed income more broadly then, right now?
Yeah, no, I think it looks quite good in terms of the fixed income outlook when you look out over the next few years, just given the starting levels of yield. So we've seen repricing across global markets. You have central bank rates and expectations higher, 10-year rates higher. Broadly, it looks kind of broadly fair to us. We think that you've seen a lot of the repricing, and that means that when you look at core bond funds, you look at a US core bond fund or a global fund, 5.5% type yields more when you are looking at credit. So as a medium-term view, that looks really attractive. In the short term, there's the uncertainty your reporters have been talking about. There's uncertainty about the economy, the Fed, central banks more broadly. So tactically, I think it's a difficult time. But looking out over the next few years, the outlooks for global bonds, US bonds, looks quite attractive here and a lot better than it was looking 1 or 2 years ago.
Andrew, can we strip out credit and look at sovereigns and almost treasuries just exclusively, just for a moment? Last time we had a big inflation shock several decades ago, it was followed by a big disinflationary bust and a multi-decade bond bull market. Is it too early to consider the destination, whether we're returning back to that kind of theme out of this one?
Well, so the starting levels are different compared with the very long-term returns to bond markets. But the levels you've seen, or look at forward rates now, so you abstract from the Fed tightening cycle, it looks pretty reasonable to us. And there's various gauges that you use. You might compare nominal growth with your nominal yield, but it looks reasonable. So I can see two-way risks to the US 10-year here. And then we have this recession risk. So worst recession risks, equity market underperformance. There's the potential for capital gains in bonds, which you wouldn't have seen 1 or 2 years ago. So the baseline looks pretty good in terms of yield levels. Broadly, we're pretty neutral on the US duration here. In the next few weeks, this could go higher, this could go lower. But I think the medium-term returns, the value is there. And also, after a difficult year for returns across asset classes, and so equities have underperformed, bonds have underperformed, the potential for re-establishment of more normal patterns with bond market and equity markets not moving in the same direction as they have been doing during this atypical period.
Andrew, speaking to Pimco over many years, typically when you anticipate a tough time, you raise cash and you get ready to be so-called liquidity providers. And I see that in the language of your outlook once again. Can you describe the moments that you actually do want to be liquidity providers and the moments you don't want anything to do with it? And can we use the gilt market of the last couple of weeks as an example? Did you step into the gilt market to provide that liquidity, Andrew?
So not in large size. So gilt markets, we've been underweight UK interest rate risk, and we've not huge positions. We've bought a little bit during this period, and I just think the level of gilts now looks quite reasonable versus treasuries. After a long kind of aberrational period, you might think where gilt yields were lower, big unpleasant adjustment, but we now see pretty reasonable levels for gilts. And so, and more broadly, I think when you look at high quality duration, high quality corporate credit, you can think about currencies over time. There's a lot of good potential trades to do as you get some clarity on the Fed cycle, the global central bank cycle. At the moment, as you said, we think it's right to be pretty careful there. Look at the volatility in equity markets last week. There's a lot of uncertainty about this point in the cycle, but over time, if you go into this sort of slowdown, this sort of recession well prepared, then you've got the opportunity to add high quality assets at cheaper prices, take advantage of dislocations, be liquidity providers, as you said.
Is the Italian 10-year part of that story, Andrew?
So we've been underweight Italy. You have seen significant moves in European fixed income this year. The level of the moves in bunds, for example, given what's happened with treasuries, a bigger move in terms of bunds or the beta of bunds to treasuries than you would normally anticipate. And in that environment, the higher beta assets are going to underperform. So Italy has done that. We've tended to be underweight Italy during a period where the ECB is tightening on the basis of this high beta nature of the Italian market. I think it's becoming more interesting. You have a lot of political risk and uncertainty there, but I think over the weeks we'll get more comfort in terms of the political framework. So tactically underweight, but I think with a medium-term view, you could be positive there, and it's going to be interesting the extent to which the Europeans are cooperative in terms of the energy price shock. I mean, is there the potential for common bond issuance in Europe as we saw during the COVID period? I think if we start to get the sense that could happen, that's a real positive, I think, in terms of Europe and the medium-term outlook.
Well, let's dig deeper in Europe then. Does your view on the sovereign, to what extent does that shape your view on the underlying credit of those countries? So let's say Italy, and let's say corporate credit, bank credit. Andrew, does your view on the sovereign shape your view on bank credit in the same way it did maybe 8, 9, 10 years ago?
Yeah, so I think banks, you always look at the relationship with the sovereign. More generally with industrials, there's more of a debate, but I think that the level of yield of the sovereign is very important. In general, we think that it's better to be in US credit. So we tend to be underweight European corporate credit, overweight versus that in the US in terms of industrials, and I think that makes sense. The Russia shock energy, this is much more of a European event, much more uncertainty in Europe. I think European financials, if you're at the higher quality part of the market, I think they look fine. I think they look relatively attractive. But at a time when you can find good value across the board, there's no reason to go down in quality. You can stick with the higher quality names and sectors.
Andrew, I wanted to finish on a question that I explored with Rick Reeder of BlackRock on Friday. I'd love your view on it too. Andrew, we've just had a decade of QE, trillions of dollars of it. We've had negative rates at central banks like the ECB, the S&P and elsewhere, and we've seen those negative rates captured in sovereign debt markets and corporate debt markets as well. We've blown that up in 12 months. And Andrew, all I hear from fixed income strategists, people who run portfolios in fixed income, is that there's resilience in credit, that things will be okay, that we've done a lot of work with balance sheets, we've pushed out maturity walls into the future. Andrew, do you think we've fully realised the negative consequences associated with blowing up a decade's worth of zero interest rates?
Well, I think there's 2 points I'd like to make there. So the first point is I think that you do have significant improvement across credit markets, balance sheets, greater resilience. And so I think that is right. And we think that in the environment of shallow recession, that credit markets are broadly priced for that sort of outcome. But there's a risk of deeper than expected recession, particularly I think in Europe, given the proximity to Russia and the energy issue. So in the medium term, I think there's value. In the short term, tactically be careful there. So I think that's the point you want to make. Medium term, the positive picture, but there is the risk of greater than expected recession. And related to this, and again, you saw this push and pull last week with equity markets. Inflation remains a significant problem across markets. The extent to which central banks are going to be forced higher than is currently priced in is something that you need to be very clear about. So with credit markets, we would make a distinction between long-term investments going in to buy cheaper assets where you're high in the capital structure, where you are very, very default remote, but being careful. There's no reason for us to go down in quality with cuspier credits at this stage of the cycle.
Hey, Andrew, wonderful to catch up. Enjoyed reading the outlook. Andrew Balls there of Pimco. Coming up on this programme, the US imposing fresh technology curbs on China.
Companies are investing in America, and we're all making sure government delivers. The infrastructure law, the CHIPS and Science Act.
That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Ed Morse, Citigroup Global Head of Commodities Research. That conversation, 10:30 a.m. Eastern, 3:30 p.m. in London. This is Bloomberg.
We celebrate workers. We're the backbone of the economy of this country. Workers in Syracuse, where the company Micron is investing $100 billion to manufacture computer chips, the biggest investment of its kind in America, biggest investment ever in the world. Companies are investing in America, and we're all making sure government delivers. The infrastructure law, the CHIPS and Science Act.
The Biden administration unveiling new restrictions on tech exports to China, the latest curbs weighing on global chip stocks. The Commerce Department writing in a statement, these updates will restrict the PBOC's ability to both purchase and manufacture certain high-end chips used in military applications and build on prior policies. Kelly Lyons in New York, AMH down in D.C. Anne-Marie, the latest.
What we're hearing from the Biden administration, Jonathan, is not just this makes sense for the administration in their domestic push after the CHIPS Act this summer, but really what they're trying to do is thwart China's capability, one, in the semiconductor industry, but also in their military capabilities. Let me give you a little bit more of a statement from the Commerce Secretary, an Assistant Commerce Secretary for Export Controls on Friday. China has poured resources into developing supercomputing capabilities. It goes on. It is using these capabilities to monitor, track, and surveil their own citizens and fuel its military modernization. Now, depending how much this is impacted in terms of the controls on what sectors, which companies, and how far they go, it can reach, Jonathan, a broad scope, whether it's EVs, the military, aerospace, and smartphones. But the big question is, what's the scope going to look like?
And Kaylee, pretty clear how this is playing out in the market.
Yeah, in that chip stocks are down really across the world. It started in Asia overnight, and you're seeing those names under pressure a few minutes into trading here in the U.S. as well. An analyst at Bernstein, for example, saying that this is a further escalation, revokes potentially, or could evoke retaliation from China. Morgan Stanley saying the broadened restrictions could be disruptive and create supply chain issues for companies like Intel and AMD. And Citi saying Intel, AMD, Lam Research all could see between 5 and 10% of their sales impacted by these new rules, and that could, of course, drag on their ultimate earnings, which already weren't in a great place. We've had a series of warnings from semiconductor companies over the last few weeks about plummeting demand. And then, of course, in Asia, you add on these new cocktail of factors for the chip space, 2 regulatory pressures from Beijing and an economy hit by COVID-0, which is all why we have seen the Hang Seng Tech Index down about 60% since March of last year, drastically underperforming tech peers in regions like the U.S. and Europe. It's been absolutely brutal, John.
Kelly Lyons, thank you. Wonderful work. To AMH down in D.C. Anne-Marie, thank you very much. Equities down about 0.2% on the S&P. On the Nasdaq, we're down by 0.6% on the S&P, looking at a 4th day of losses. Coming up, the market moving events you need to be watching. That'll be next in our trading diary. Live from New York, this is Bloomberg. 25 minutes into the session, we are down across the board now on the S&P. We're down for a fourth straight session. We're off by about 1/3 of 1%. On the Nasdaq 100, we're down by 3/4 of 1%. A little bit heavier in the last 25 minutes or so, rolling over in the equity market. That's the price action. Let's get you your trading diary. Fed Vice Chair Lel Brainerd delivering remarks at 1 p.m. Eastern. A host of Fed speak throughout the week with Mester, Kashgari, Barr and Bauman all on deck. The FOMC minutes and US PPI coming up on Wednesday. US CPI and initial jobless claims out on Thursday. Then Big Friday as well to close out the week. Retail sales in the morning alongside big bank earnings with JP Morgan, Morgan Stanley, Citi and Wells Fargo all reporting on Friday morning. Live from New York City, that does it for me. Thank you for choosing Bloomberg TV. For our audience worldwide, this was the countdown to the open. This is Bloomberg.